Yeah, I mean, if you take a look, Al, if you look at the history of the overall markets, 15 years, all right, stocks haven't gone down in 15 years. So if you have enough liquidity to start pulling some money from your bond portfolio, your safe money, you're going to be okay and weather the storm. Here's another thing that you got to take a look at is fees and costs. All right, so if you purchase an index fund, right, that's the cheapest investment. Now remember, all investments have costs and fees associated with it. An index fund is one of the cheapest in an exchange-traded fund or an ETF. You're looking at an average fee of 0.3%. That's pretty dirt cheap there. Then if I want to get into an average retail mutual fund, this is what most of you are probably invested in inside your 401k plan, maybe your brokerage accounts, if you are invested in mutual funds. But just know, internally, you're paying about 1.3%. Okay, so that's your operating expense. That pays for the portfolio manager, advertising, and so on. Then there could be pretty expensive types of products out there, such as annuities, for one. Okay, the average fee, you could look anywhere from 2 to 4%. These are very high-cost products. They have some benefits, so you want to make sure that you really take a look at those benefits to see if they're going to work for you. It depends on your age, your tax bracket, so many different considerations. But just know, this is a huge cost, all right? So things that you can't control, one of them is the risk that you're taking, how you're constructing the overall portfolio, and then the fees. Because does it really matter? Well, yeah, 2% fee, right? 2% extra cost. So if I have a long period, right, it's $100,000 invested over 50 years, okay? So the difference here is about $2 million on that 2%. It's a big deal. But let's not get too focused on fees here, because here's the biggest problem in my eyes. Let me go back to this slide here. Is that, all right, you're missing 7% out of the overall market because you don't have a disciplined approach. Right? You do not have a disciplined approach. So if I'm buying the cheapest investment, but if I'm getting in and out, in and out, in and out, right, I'm still going to get lousy returns. So you have to take a look at your goals. Invest for your goals. Have that right portfolio. And know that stocks will go up, stocks will go down, and rebalance and tax manage as appropriate.